Hey guys, welcome to the Titanium Vault. I'm your host, RJ Bates. Today I'm sitting down with Toby Mathis. How you doing, man?
I'm doing awesome.
Yeah, well, I'm excited to have you here. We're going to talk all things asset protection, tax advice. We've got a top-notch attorney who has tens of thousands of clients from across the country. So why don't you take a quick second to kind of briefly introduce your company and how you got into being an attorney in the real estate investing industry?
Oh my goodness. All right. So as you said, I'm an attorney, but I'm not that type of attorney. I'm the good kind of attorney. A lot of people want to kick their attorney. Got into becoming an attorney because I didn't like attorneys. I had a mentor. I was very, very lucky to have a guy that his son was a very good friend of mine, and he brought me up on how to be an independent business owner. So we all the son, the dad, and I all went to law school at the same time. It was kind of funny. Dad got kicked out. He didn't know how to shut up. He was one of those. They don't like you there if you're challenging the professor all the time.
Right.
Awesome guy. And he also was introduced me to the first real estate investor I ever met was a guy named Boyd Watkins out of Burien, Washington, who had hundreds of properties to his name. This is back in the 80s, all in Seattle and Denver. And he just said, hey, if you ever get in whatever you're doing, buy real estate. He goes, it'll treat you good and it'll pay you forever. So I follow that. I have over 100 properties myself with my partner Clint, and we work real hard to grow our firm. We have over 30,000 clients nationwide. We've taught, and we still do teach for the groups like the Rich Dads of the world, and groups that teach real estate investing. We come behind and teach you how not to lose it all to the tax man, and how not to get it taken away from you by tenants that have that drive down the freeway and see that advertisement for a lawyer and think that you're their lottery ticket.
Right. So we were briefly chatting before. I went onto the Vault, which is our Facebook group, and I asked people like, hey, there's some questions that you want answered in this, and one of your clients hopped on there and said, I absolutely adore Toby. He's a blessing to have on our team. But why do attorneys have this like negative connotation? Like, I can't stand attorneys, no offense, but I don't even really know why. I mean, what is that?
Well, okay, so you learn how to use a weapon, and the weapons are words. And so all it is that if I walked up and put a gun to your head and said, give me 20 bucks, I go to jail. If I put a lawsuit to your head and say, give me $20,000, I get paid. And so it's rewarding bad behavior. And before all the plaintiff lawyers out there start giving me all this crap about, hey, we do it because, the unrepresented and you have these unequal. Yes, there's that case, but the vast majority of the time, what I see in business is shakedowns. I see legalized extortion. So a lot of people don't like it. And lawyers tend to think very impersonally. In other words, you learn to think like a lawyer in law school, which means take the emotion out and take the equation out, take the people out. You start thinking of people as plaintiffs and defendants, and the whole world becomes one big old, here's a client. And I can tell you, go into court, and I've clerked for 3 different judges. I've been there, done that, have that t-shirt. And I love them, but you never want to be in court. It's not a good place to be. It's just like, if you can avoid it, avoid it. And you want to force settlement, and you want to pay your debts. And I'm the first guy to tell you, like, if you owe somebody, pay them. Right. If they've done you wrong, then try to resolve it outside of a courtroom. If you have to go to a courtroom, it's last resort. Problem is, a lot of lawyers think it's first resort. And like, I guess the old adage is, when you're a hammer, the whole world looks like a nail. A lot of these lawyers make their living driving nails, and they're just trying to find nails out there, and they're advertising for them, and they're just looking, and people are unwittingly becoming that nail.
Yeah, and just from my personal experience, it's always kind of been like, I felt like anytime I needed an attorney for whatever reason, it felt like a very elongated process to where, the hours were their way to make money. And I'm kind of going, you just spent 6 hours to essentially ask me what I want you to do. And then I told you, and you wrapped it up in 20 minutes and then billed me for 6 hours and 20 minutes. And I'm like, that was not a pleasant experience. So I know you have a ton of value to bring to today's episode. So I really want to dive into some of these topics. Mm-hmm. I just want to jump into probably the one question that almost all real estate investors have, which is, how do the rich avoid paying taxes, right? I mean, as investors, we hate paying taxes, right? That's like the worst thing in the world for us. So what are some of those tips that you have for us?
Yeah, if you never want to pay taxes, it just don't work, right? No, they'll probably give you some money to sit on your butt. No, the how do the rich not pay taxes? Is they use the laws as they're written. So, for example, we have a president right now that's taking some heat because he doesn't want to release his tax returns. So that's because most people won't understand it. But like I know a few of the things that he does. He uses conservation easements, for example. So he's always going down to the summer White House, right? Whatever they call it, the Mar-a-Lago. He goes down and hangs out on his golf course. Regardless of whether you like him or not, Trump uses the tax laws to his benefit. And one of the things he did down there was Mar-a-Lago, I think it's 6 parcels. And it's a big golf course. So what he did is he gave the rights, development rights, future development rights, to somebody, to a conservation group. He says, we'll never develop this. We'll never make it into tract homes. We'll never do any of that stuff. In fact, we'll even give to a preservation foundation all of the antiques and everything that are in the clubhouse, and we'll make sure that we never dispose of those. We'll always keep them there. And we'll have a gala every year, and you guys can go look at the antiquities, that sort of thing. He did that with 3 parcels and got about a $5 million deduction. It didn't come out of pocket. What he did is he restricted his right on that property, and it devalued the future value of the property. In other words, if you really wanted to make the most money on it, you would develop it and sell it to builders, and they would build houses on it. But he wants to keep it as a golf course. So that reduction in fair market value, he took as a charitable donation. He did it to the tune of about $90 million in New Jersey on his courses there. So yeah, so he conjures up out of thin air. He goes, oh, I think I'll create a tax deduction over here. I think I'll take another one over here. And we all have that ability, especially in real estate. And that's because there's incentives in the tax code to be an investor. You want to get beat on every dollar you make, go work at McDonald's. They'll hit you with old age, death, and survivors, Medicare, FUTA, SUTA, and withholding and state. They'll hit you with like you look at your paycheck, you're getting it all. You own real estate, there's a good chance you'll never pay tax. And by the way, if you die, your basis steps up and your kids won't pay tax.
So let me ask you this. I mean, I highly respect our president. I think he's a brilliant man, but he's also a very busy man. Like, he's not sitting there coming up with these decisions himself, right? I mean, who is it on his team that says, hey, let's take these 3 parcels and this is the strategy to get this tax cut? Who's doing that?
It's a tax planner. And there's a big difference between a preparer and a planner.
Hey, let me go ahead and not be prepared for this podcast and have my phone on ring there.
I didn't hear it.
This is the 91st episode, and that's the first time I've ever had my ringtone go off mid-interview. That's awesome.
I didn't hear it.
Okay, so who on Donald Trump's team is coming up with this strategy for him?
I forget the guy. I don't think it's
a guy. But is it an attorney? I mean, is it someone in your role?
More than likely, it's an executive who has experience in the area. So here's the hard truth. If you want to learn how to do tax planning, talk to somebody who's been an investor and who's done it, and learn from somebody who knew how to get the path. So here's the example I'll give you, RJ. So if I flew into I use this example sometimes. If you go into Orlando and you're going to go to Disney World, and you follow all the signs, you will go and you'll hit every toll booth on the way to Disney World. But the very first exit when you leave that airport, you could go to Sand Lake Road and you could avoid every toll all the way to Disney World. The only difference is that it used to be you had to know somebody that was a local to say, hey, get off the tollway and drive down this road. And now you have Google where you can say avoid tolls. And it'll tell you. Well, the tax code's no different. There's 2 tax codes. There's the tax code for the rich and the tax code for the poor. Or there's the tax code for the informed and the ill-informed. You don't have to know the whole tax code. We don't have to know all the roads in Orlando either. We just have to know the road that avoids the toll. And maybe I have to stop at a couple red lights along the way, whereas the tollway would have gotten me there 5 minutes earlier. I get to make that decision. If I want to avoid the tax, I can avoid the tax. If I want to pay the tax because it's more efficient and maybe it's because it's less bother, I can do that too. And so I always say it's like tax appetite. How hungry are you? If you're getting killed in taxes, you're pretty hungry. If you're not paying taxes anyway, you don't really care. So
let's talk about some of these loopholes that you're talking about. What are some of the top ones that for someone that's breaking in, I think the majority of our listener base is going to be somewhere in the mid six figures to the, maybe $2 to $3 million range. That's kind of where I think the majority of our listeners are ranging. What are some top loopholes that those types of businesses are missing right now?
Well, the first thing I would do is say that as an individual, if you're making over $500,000, you're going to be in the top tax brackets. So every dollar that you make, depending on what state you're in, like if you're in California, you're paying 50%. You got 13% plus 37% federal tax. You got 13% state. Plus you have the net investment income tax of 3.8. They have all these little taxes that they tag on you as an individual. So the first thing I would say is you got to get really good at income shifting, which means creating other taxpayers. We're all used to doing it, and we all know what it is, but we don't realize that we're doing it. So for example, going back to the president, Donald Trump, his dad figured out, hey, maybe if I pay my kids, that's going to be a lower tax bracket. Fantastic. Maybe I'll have a corporation make some of the money. Fantastic. Maybe I'll fund an IRA. Great. How about a 401k? Perfect. How about the type of retirement account that nobody knows about, but that has more money in it than the 401ks all added up? That's a defined benefit plan. That's only for the rich. I'll tell you that. And maybe we do that. And maybe we're just starting to push the assets over here. So for example, let's say one of your listeners has kids and they're putting them through college. Quit paying for your kids' tuition. Pay your kids out of your business and let them pay their own tuition. It's gonna put it in a much lower tax bracket. In fact, they may be paying zero. My daughter graduated last year and her tax bracket was way better than mine. Something that I would have paid $4,000 or $5,000 on, for her it was $400 or $500. And so we literally get to keep that money in our family. And you just have to start thinking about that.
Right.
You just need a guide who says, hey, here's your options. Here's where we should put it. Here's the good, the bad, and the ugly. If we do this, then here's what happens. If we do this, then here's what happens.
Was your daughter a member of the Wolf Pack?
Yes, she was. You can tell.
So I was about to say, I mean, you're wearing the Nevada shirt, so I had to ask. So is Anderson Law Group, your company, is that something that you guys specialize in and help investors do? Out of the 30,000 clients, is this something that y'all help with?
Yeah, that's really what it boils down to is when I look at somebody, I'm going to try to create a blueprint for them, say, hey, here's what it would look like. And then on an annual basis, you're just tweaking around. You're saying, let's see, let's try this. And I'll give you a great example. Somebody comes in and they're going to buy real estate and they start buying some rental properties. And that rental property is breaking even. We don't have a tax appetite on it yet. But let's say, I'll give you a prime example. This was from one of my classes about 2 months ago. It was a doctor who was making about $1 million. It was the wife that was making about $1 million, and the husband is doing real estate investing. And I explained to him, hey, if that's all you're doing, you're going to be a real estate professional. That means that your losses on real estate actually can offset your wife's income. And it could have a pretty dramatic impact. They were in a high tax state, so they were paying on every dollar about 50 cents. So if we can create losses, and he said, well, I can't create losses. I'm breaking even on my real estate. My depreciation offsets my income, so we're at zero. I said, you're thinking and you're limiting your belief to what you've been told, which is that when I depreciate real estate, I depreciate it over this long time horizon, like 27 and a half years, or if it's residential, 39 years. A lot of people don't realize you can accelerate that. That's the starting point. I could take about 20 to 30% of that value of the business and depreciate it and take it this year. It's called a cost segregation. And I can take it in their particular case, they did one property and it was $178,000 deduction. So what was it worth to them? Half of 178, whatever that number is. It's a lot.
Yeah, that's massive. And to have someone on your team, I mean, that is giving that sound advice, I mean, over the course of, 3, 4, 5 years, that's a drastic difference to where their business is going to be. But one of the things that I've really been focusing on here over the past 3 or 4 months is really not hiding on a platform or hiding behind a microphone and talking about how everything's roses and rainbows, and really kind of talking about, hey, there's struggles in trying to scale your business and continuing to grow. And I want to share some of the struggles that we've been going through And one of those things that I've been talking about recently is the nightmares of trying to scale your business and what that does to your cash flow. So let's talk about, if I'm sitting down with you, and maybe this is going to be difficult to give a quick, precise answer, so I apologize if that's the case. But if I'm sitting down and I'm saying, hey, we need to do something to, relieve the tax burden that we're going to have. But in using your example of like, well, maybe we'll fund a corporation here or an IRA or 401k. When you're talking to someone like me that's got these massive goals and I want to continue to grow, it's a fear of mine to say, I don't want to put a lot of cash in a 401k or an IRA where I may need that liquid cash in 6 months because of cash flow issues. If something comes up on a larger project or a portfolio doesn't start performing the way, or multifamily doesn't perform the way we thought. So what is your advice to someone in that position going from, 1, or let's call it 2 to 5 million, trying to scale to 10 million? Because those are really, like, almost every entrepreneur I've talked to in that position says that's kind of one of the hardest times, right? Like, to go from that level. So what's your advice there?
I love that question. I've never been asked that question on a podcast before. You're going right into my wheelhouse, by the way. So the 0 to 1 million is a different mindset than the 1 million to 10 million, and the 10 million to $100 million is a complete other mindset. There's actually really good books on it. Vern Hanisch wrote one called Scaling Up, The Rockefeller Habits. There's Traction that follow the Rockefeller Habits. And what it really comes down to is, you have to morph yourself. You got to surround yourself with excellent people. So when you're scaling up, cash is king. I'll just be like real serious.
Right.
And so you start looking at things that are going to allow you to preserve your cash by minimizing your tax liability. In fact, let's see if we can defer it out. If you get over $5 million, you go to accrual-based accounting, and we could start accruing liabilities, not paying tax on income until sometime into the future. In real estate, we can depreciate the heck out of things. In a traditional business, we can buy things, even on credit, that create massive tax deductions now. So for example, I'll give you one of our cases. We were sitting on about a $2 million profit one year, and I looked at Clint and I said, I don't want to pay tax on it. Do you want to pay tax on it? I don't want to pay tax on it. I said, well, we have 3 buildings down in Vegas. I said, let's put a bunch of new copiers in them. Well, here's the funny part. A lot of people think you have to buy it. No, you can do a lease with a paid on termination of less than 10%. It's capitalized. In that year was 100% bonus depreciation, which means I didn't come out of pocket anything. In fact, they gave me $37,000. No, it was 57, excuse me, to pay off my previous leases. Like, here's the money that you're going to owe on your past copiers. And then we bought $2 million worth of copiers, and guess what our tax liability was? 0.
Wow.
So, but here's the rub on that. I can get your liabilities to 0. We could buy other assets. We could buy commercial real estate, for example, and take a huge deduction in year 1, even if you're buying it on credit. But you show a 0 on your tax return and you're trying to scale up, it's going to be really tough to get a loan.
Yeah. And that's the give and take as well, right? So when we're trying to scale up, and you're talking about buying real estate, so then we could depreciate it to limit the tax liability, but then we're going to banks saying, hey, here's my tax returns, and they're going
to say, what are you, a tax cheat?
Well, and I kid you not, man. There's a local bank here in Fort Worth. I won't name them. I've used them for probably 3 to 4 years to get small, like, single family loans on rental properties. And every year he wants to have a meeting with just me, and I go in there, I give him the P&L, the personal financial statement. And every year he just looks at me and he goes, you just don't make any money.
Mm-hmm.
And I'm like, well,
we can fix that like that.
I'm like, yeah, maybe, but that part of that is a little bit strategic, but it's also because I don't have someone like you on my team that maybe is balancing that equation out, right?
You know what you're running up against? And we see this all the time. And I tell you what, your accountant's not going to get it. Your attorney's not going to get it. You got to deal with people that actually do what you do. So I own a lot of properties.
Right.
What it's like. And I had 0 tax returns where they're like, what the heck? What are you, a tax cheat? And you're like, no, we get all these tax benefits. Yeah, that's great.
Right.
You have to have a banker that understands it, or you have to make yourself look the way the banker wants you to look. So the question I would go to your banker is say, what do you need me to make? And then I would make sure your business is not a flow through business.
Right.
I'd make sure that while you're growing up and where you're drawing your salary from is an entity that does not flow onto your tax return, but is a separate taxable entity. And it's paying you a W-2 wage. And you're going to say, well, wait a second. I'm getting this W-2 wage. This is going to be horrible. Now I'm going to pay tax on all of it. To be able to grow, that's a small price to pay. But
right.
It's not going to be $1 million that they're going to want to see. It's probably going to be like 150 or 200,000. Fantastic. Well, I can fund a retirement plan. I can put almost, in many cases, all that money into a retirement plan. It still shows up as my taxable income. In other words, when I show them a W-2, it says 150. That's what they need. When they start looking at your tax returns, if you're a real estate investor, watch their eyes roll back. They're not going to get it. They don't understand the Schedule E. They don't know the difference between page 1 and page 2.
Right.
Know the first page of that 1040, and maybe they know a few of those lines. And you just get yourself in hot water.
So you brought up on my previous question that once you start eclipsing that $5 million mark, that's when you need to go to the accrual accounting system, right?
Yeah, technically you're required to. So you start going over a certain dollar amount, you're going to be on a traditional business, you're going to be looking at changing the type of taxpayer you are.
So let's say I have 5 entities and they're each doing $1 million a piece. Is that when we need to do it, or is it an individual entity is going over the 5 million?
It's an actual individual business that we're looking at. Now, technically you could do accrual-based accounting under many circumstances.
Right.
But what we're looking at on accrual-based accounting is being able to accrue liabilities that haven't had. Otherwise, if you're a cash basis, just to make sure that it makes sense. If I'm a cash basis taxpayer, I recognize income when I receive it. I get to write things off when I pay it. If I'm accrual based, then I recognize income even before I receive it if I'm owed that money. And if I owe money, I can take that deduction even before I pay it. And so you can have massive liabilities. So for example, if I'm getting paid $1,000 and I know it's going to cost me $800 to fulfill it, I'm only going to be taxed on $200 in that year, even though I haven't paid the $800. Right. It allows companies to be more accurate in their reporting. So when you're doing it, because otherwise cash basis, we can make those numbers jump all over the place.
So one of the questions that, I see in Facebook groups, and we're in several masterminds, everybody's got questions about the new tax laws. What can you tell us about that? What do we need to know about the new tax laws?
So for real estate investors specifically, I'll just hit on as an individual, as a human being, they eliminated miscellaneous itemized deductions, which means if you were filing something on a Schedule A, you're probably hosed. They raised the standard deduction, so now it's over $24,000 as a married couple. I think it's $24,400 or $12,200 this year. And unless you're exceeding those, you're not getting any benefit for your for the interest you're paying on your primary home loan. You're not getting your charitable deductions if you don't exceed that, and medical, if you have to exceed 10%, you're not getting that. And then if you live in a state that has state taxes, or you're paying real estate taxes, you're capped at $10,000. So if you're like in New York or California or Connecticut or Maryland, where you're paying $40,000 or $50,000 a year, you're only going to get to write off $10,000. So like that really stinks. From a business standpoint, they gave us a lot of benefits. They capped C Corps at 21%, a flat tax. And if you know how this works, most accountants immediately regurgitate something they learned years ago, which is double tax. And they, double tax bad. It's almost like a caveman. Bad. It's not. You have to actually pencil it out. What it is the corporation pays tax, and if it pays it to its shareholders, they pay it at the long-term capital gains rate, which could be zero. If you're less than $79,000 as a married couple, you're paying zero on your capital gains. Like, I don't really care about that. Worst case scenario, you're paying 20% on it. So I kind of look at it and say, but why would I issue it? Like, I could count on one hand how many times we issue dividends. You're just going to sit on it, and you're going to wait, and it's being taxed at 21%, whereas as an individual, I may have been hit at 37 to 50%, depending on where I live.
Right.
Keeping a big chunk of that money, and then say, well, how do I get access to the money? Loan it, borrow it, have it be a partner in something.
Right.
just another person. It just pays a lot less tax than you.
So
And
when you say loan it, are you saying like that corporation is then going to loan it to another one of your companies, maybe to purchase a property or something along those lines?
exactly, like there's no reason that, like, it's truly an artificial person. So could I use it to, you have to pay it interest if it's over $10,000.
Right, right.
You got to pay it interest. Fine. I'll pay some interest. It's 21%. Like, I'm not worried about that. And I'm going to offset it with other expenses. What I know is that I can actually partner up with it, or I could borrow the money. Worst case scenario is I pay it out to myself. Like if I had money go into a corporation and the accountant immediately goes, double tax, that's only on the profit. If I pay myself a salary and fund a retirement plan, I may not pay any tax anyway. And I just avoided all taxes.
When you say it has to pay interest, does it actually have to make monthly payments, or could you have an agreement where it's accrued interest and it's paid off at the time of closing?
Right. What happens is the IRS is going to impute interest to it, whether you pay it or not. And so it's usually going to be about 3%, 4%, right in that range. I think it's right around 3% right now. We use the federal rates. Gotcha. So let's say that you loaned you $100,000, you're going to have to recognize $3,000 of interest as though you paid it to the corporation regardless. You don't actually have to make the payment. In fact, you're taking a deduction too, and the company's recognizing some income. I would just pay it. I'll make it real simple. Hey, right. I'll make some interest. It looks good. Do it once a year. It doesn't really matter.
Put a paper trail there so you know you're not getting in trouble.
Yeah.
What is one piece of advice you would give to someone if they were just starting their business today?
Cash is king. Don't run out of cash. Be careful about the debt. And I would say that there's the only thing that really kills a business is when it's running out of capital. So I hold on to it. And so let me give you a really good example. Had a guy from Microsoft. He was a Microsoft contractor. He was making about $200,000 a year. And he was feeling the squeeze because Microsoft would pay him as a contractor about every 30, 60 days. So he had to pay his contractors, the people that worked under him, and he had to borrow money every month to do it. So he kept a balance on his credit cards of about $70,000. When we added it up, it was about $11,000 a year that he was paying in interest. So I looked at his business and I said, hey, if we just slightly structure it differently, in fact, you could still have access to all the money. We just made him an S corp. And it eliminated a big chunk of the self-employment tax he was paying. Plus, we added a little 401k onto that. For a lot of people, they don't realize that with an IRA, you can't borrow from a 401k. You can actually borrow from yourself up to $50,000. And so what we did is we rolled his existing IRAs. His wife had 130, he had 90. And we borrowed the money out of his own 401k and wiped out his credit card bills. We made him an S corp, which saved him about, I think it was $9,000 a year. It saved him $11,000 a year in interest on the credit cards. He still pays himself interest, but it's to himself. And what it ended up doing is giving him literally, it was a 10% of his income just boosted up through the use of two simple structures. But here's the rub. Because he got rid of that $70,000 of credit, his personal credit score went from 680 to 770.
Yep.
So he was able to get a better interest rate on his house, and we calculated the savings over the 30 years, and it was over 200 grand. And he was able to get credit cards in the company name that weren't reported to his personal credit, and that was over 100,000.
Yep.
Now he is not in a cash crunch. He's keeping more. He has access to all that money. He has $70,000 on his personal that he like we just paid back, but that credit is still there. And he had another $100,000 in his business. And over the life of that business, it's probably going to save him $300,000 or $400,000 just in interest payments. So
on top of that, if he leverages that credit score correctly, I don't know if he's an investor or not, but you could go get travel credit cards, put your rehab on there, and immediately pay it off, and you get those travel points. And before long, you're traveling the world free. Just off of one particular move that boosted that credit score. And again, this is, as investors, so often we want to talk about these magnificent moves of, leveraging and like you've already given some amazing golden nuggets today about, how you can even loan from, one corporation to, another entity or to yourself. But, it's also about leveraging these other benefits that are out there to us, right? Leveraging your credit score and how that benefits your lifestyle in the long run. So that's amazing. We get these sheets that give me questions to kind of ask you, and the last one on here says, what makes you different from the majority of other lawyers? I'm going to skip that one because you've already given us that answer. I mean, you came in here and just crushed it with the gold nuggets. But we did have one of my favorite listeners, Matt Smith. He did ask a question. He wanted to know, do you need a different entity for active income compared to your passive income?
The answer is I would. I'd separate them out. And the way I describe this in events, I teach classes all the time, is that, well, I went to Catholic school. And so when you're goofing off, I always say that's over here. I'm goofing off over here. The nuns would just whack you, and like I had ones that would throw erasers at you. So that's active income. You're getting hit with self-employment tax on it. You're getting hit with old age death survivors Medicare, Fuda Suda, you name it. They're just nailing you. That's like it. So and it is kind of funny that tax comes from the Latin word taxare, which means to censure or express severe disapproval. So I always look at it like, if you're paying too much in taxes, you got to pay attention. That's somebody telling you something. Then you get then when you're being good and you're walking the old lady across the street and stuff, they're giving you noogies and they're telling you what a great person, you're going to go to heaven and stuff like that, and your mom loves you. That's over here. That's passive income. I could literally make, like when I worked at McDonald's when I was in high school, every dollar they nailed. When I go over here, and I have, we have north of 130 single families. We have some other stuff too, but I could trade those into more properties. I could sell them, and let's just say they were worth $5 million, and I put it into $5 million. It turns into $10 million. I sell those and put it into more properties. I pay zero tax. And then when I die, my daughter could literally sell it all and pay zero tax. Actually, my wife could. I'm in community property state. So if I died, she could sell my entire portfolio the day after I died and pay zero tax. So that's the difference between active and passive income. Passive income is rents, royalties, dividends, interest, and capital gains. And you give it big kisses. You give it noogies. That's over here. And so you really do want to cut it and make it separate. In our real estate world, this is when you're flipping houses. You're going to get hit. You can't, we were talking earlier about installment sales for the show. You can't do an installment sale on a flip. I can do an installment sale on over here on investment properties, and I need to make sure that the IRS knows those are separate. So I would actually use a separate entity for those different activities. I'd have a corporation, either an SRC or an LLC taxed as an SRC, doing my flips, and I would just have a holding pass-through entity, either a partnership or disregarded, for my rental properties. And I would make it really simple, like, hey, IRS, you can see exactly what I am. You know exactly which two types of income these are. And the beautiful part, if I do it right, I can change that active income into a passive income if I really want to.
So I'm so glad you brought up you dying. Let's talk about that. How should a business be passed down to your spouse or your kids? What's the appropriate way to do that?
All right. So the answer to that question is kind of twofold. First off, if you have partners, then the question is, does your partner want your wife or your kids as their partner?
Right.
And if the answer is no, then I would have a buy-sell, and I would fund it with life insurance. So if I die, for example, if I die in my firm, I'm an attorney. So I can't give it to my wife or my daughter. They're not attorneys.
Right.
Smarter than that, right? No, what I do is, so Clinton and Michael, we have another third party, but Clint and I did this a long time ago when we started the firm, is we said, look, if I die, let's make sure we have lots of insurance. The benefits of the proceeds of that insurance policy go to my wife. Same thing with his wife and me. And then we take over the firm. So we own it. The surviving partner keeps going on with the firm. And we documented that ahead of time. You need to do that if you have partners, because you don't want to.
Also advise that the business has insurance on you as well, because I mean you're a key part of the business, right? I mean, the business needs to realize a little bit of payment to either replace you or at least replace the kind of income that you're bringing to the company, right?
Absolutely. And so the key man policies is usually it's going to be restricted to the top 5, and they have to be bringing something of significant value to the business. And what it's there for, and there's a key man policy on me, there's a key man policy on Clint, for example. And that puts money into the company. And by the way, insurance proceeds are never taxable. So the company is going to get a big infusion of cash when I kick it. So Clint wants me to go mountain climbing. He wants me to go scuba diving. skydiving and anything else. He's like, Toby, you got to take up some more dangerous hobbies, right? Because there's going to be a bunch of cash flowing in there when I kick it, right?
Right.
So that's number one. But number two, if it's just you, I would almost always, really it's under any circumstances, I would just have a living trust and make sure that I am noting to whoever that is going to manage that asset, whether I want to keep it or whether I want to sell it. And I'll tell you what, protect your kids from themselves. So in my estate plan, they're not getting anything. They're going to get money if they need it, health, education, maintenance, and support. But I have very specifically, hey, I built up a real estate portfolio that's providing income and kicking off passive income. I never want to sell it. In fact, I would encourage anybody, that's called infinity income.
Right.
That will never stop. 100 years from now, that'll still be paying out. There's nothing else out there quite like it. So I would just say, don't let your kids sell it to buy a Lamborghini or to buy a bigger house.
Awesome. Well, very rarely do I ever ask someone to do this, but man, you've blown me away with the golden nuggets that you've given us. So give us the 30-second, 45-second sales pitch for the Anderson Law Group. How can people reach out? What's the best way to do this, and all the different help that you give people?
I'm not going to sell anything. So here's how it works. I need smart people. I need people in our firm, we want you to educate yourself. So we teach classes, we teach webinars, we teach podcasts, all that fun stuff. So just go to andersonadvisors.com, and that's with an O, or you can just type in and look for Toby Mathis. And here's what I would encourage you to do. Every other Tuesday, I do a free, open to the world tax and Q&A session. Go to that. Tax Tuesday is what we call it. We answer about 200 questions. It's just nonstop rock and roll. And you can ask any tax question you want. What I would do is invite you to get used to interacting with us, and you'll realize that we're pretty darn transparent. And where we actually start getting paid is when we put a plan in place. But you got to get your education up there so you know what we're doing. You never want to put yourself at the mercy of a professional. Right. You want to be able to control them, because otherwise what you'll find is that you're working for them. And we're no different. I say just make sure that you're really learning your stuff. And some of you guys are sophisticated, then let us do a plan for you. We'll be able to tell you what we can save you. We'll be able to tell right away, and you'll pass the sniff test. Most important thing is make sure that what you have is protected, so you keep it and you're in control of it, and that you control your taxation, because you could choose when to pay tax, especially in real estate. Choose pay nothing, man. Pay a lot.
Well, I'm going to do a couple of house cleaning items. You think about your final thoughts before we wrap up here. Guys, please do me a favor. We're looking for 5-star reviews on iTunes. If you're watching on YouTube, give us a thumbs up. If you really didn't like us and you want to give us a 1-star review or a thumbs down, just X out and forget about doing that, okay? Only if you like us. On that note, Toby, thank you so much for spending time with us. Final thoughts.
Oh, I'd say that you're in the right spot. And here's the thing. Birds of a feather flock together. You want to stick around people that actually do what you do and ignore everybody else.
There you go. All right, buddy. Thank you for taking the time today. All right, guys. We'll see y'all next week.
Thanks so much for listening to the Titanium Vault with your host, RJ Bates III. For more info and to stay up to date, visit www.podcast.thetitaniumvault.com and on facebook.com/The Titanium Vault. If you enjoyed the episode, please rate and review, and we'll catch you next time on the Titanium Vault.